Boom! What's happening, guys?
What's
Hell
going
yeah.
on?
Good. Yeah. Welcome to Real Estate Power Play. I hope everyone out there on Facebook and YouTube is doing awesome. We are here today talking about wrap mortgages. We're talking about creative financing. We're talking about selling it, some of the benefits versus some of the other creative options, and just how to structure these deals, right? How to structure them, what you need in place to really accomplish more. We got Mark Monroe. We got Marty Grisanti.
What's up?
And man, guys, we are going to knock this out. How are we doing?
We're doing well. We're doing well. I guess. How about you, Marty?
I'm doing great. You know, actually, I was just looking at some of your pictures, Mark. You were where? You were 2 weeks ago. You were at an event with Vanilla Ice.
Oh yeah. That was super cool. Yeah, I was at the. It was the. What was that called? The Family Reunion Real Estate Influencers. It was pretty
Sweet.
cool. Vanilla Ice was there. I didn't realize he's into doing high level real estate flips there in Palm Beach County. He was kind of going over a deal that he did. What they bought it for 18 million, put 3 million into it, and they sold it for 39 million. It's pretty cool. Yeah,
What a bounce back,
very
right?
cool. Yep, it was good stuff. Good stuff.
Love
So,
it.
besides YouTube and Facebook, we're actually now live on some podcasts. So, you know, whoever, if you're listening to us on one of the wherever you listen to your podcast, please, give any comments or any likes or anything like that. But yeah, I'm looking forward to this. This one, I'm going to be asking Ronnie a lot of questions. I actually have a real deal that I want to go through wrap. My exit strategies, I've always been pretty much lease options or rentals. And this one I want to do as a wrap. I've done some as an exit strategy as a contract for deed or land contract. And I know Marty, Ronnie, you've done quite a few of the wraps there. So I'm going to be asking you all kinds of questions and all that good stuff.
I think that's good. And I think what we can do, guys, is we're walking through wraps, is talk about some of the alternate strategies too and ways that we've exited, right? So that way we can do, hey, here are the benefits of the wrap versus say a lease option versus say, hey, let's hold this as a rental. And we can kind of talk about the things that we do. Because Marty, I know you've got a number of rentals and you've got a number of different things. And Mark, from the lease options and buying and then selling on the lease option. And then from me, from the wraps and selling a portfolio. And even from that side, if you decide on a wrap to get rid of it, right? Like, what does that look like? How do you offboard? So there's a lot that I'm excited to explore today. So let's kick it off, man.
Well,
Mark,
let me ask you, Ronnie, what is a wrap, first of all?
So that's great. So a wrap is where you have an underlying mortgage, whether you purchase the property or whatever, where you own it. And that underlying mortgage is used and resold, and you're selling the property to an end buyer. And there are essentially two mortgages, the underlying debt that you have, and then you have new debt made to the end buyer. And so what's happening is you're able to create a spread from your debt and what you sell to the buyer. That's a simple way of explaining it.
Okay, perfect. Excellent. So I'm actually going to pull up.
Because I thought one of the nice things about a wrap, and Ronnie, because I think what helped me learn it was actually drawing it.
Yes, drawing it's way easier.
Isn't that way easier?
Yeah.
So let's just do that real quick, because even for someone like me,
let's use this real deal that I have.
All right, let's use this real deal then, and I'll just kind of draw it out because, you know, I've never done a wrap, right? So I can't speak to it, but I've learned about it, and in the way I learned about it was through someone drawing it on a whiteboard. So that's how I'd like to do it, if that's cool with you two.
I think that's perfect. Perfect.
Cool. So let's just real quick, Mark, before we get to your deal, here's what I want to do. So here is the mortgage, right?
Yep.
And this is the original mortgage. Can we see
Hard
that?
to see that. But...
Is it kind of crappy? All right, let's try to do this.
Come on, grab a big mark. There we go.
Yeah, you got to do a big one. Yeah,
okay,
bigger.
We'll go big. We'll go big. All right. So I'm gonna do this. Well, why don't we? We weren't really set up today to do this, but why don't we just say, okay? So there's the mortgage. So Mark, let's go. Actually, let's go with your story. Let's talk about your deal, and then I'll try to like maybe draw it out while you discuss it, and then Ronnie can give us pointers.
All right. So the first underlying lien is $142,000.
Okay,
that's currently in place now.
Okay, so this is the mortgage that has $142,000, right?
That is correct.
Okay.
All right. There's a second lien of $38,000.
So I'm going to do another one around it?
Nope. You're going to do a separate circle.
Okay. So we're going to do a separate circle, and we're going to do lien. And that's going to say 32,000, you said?
38.
38,000. Okay. Okay.
Now, you don't put this in here, but I'll just tell you more of the details. So if anybody's watching, you have an understanding. So we're giving the seller $15,000 at closing. In this particular property needs about $25,000 worth of work. And this is the reason why we're doing a wrap, because on lease options, I do not recommend a seller to put $25,000 into a property if they are actually not going to own the property, because technically, if they don't exercise at the end, they don't get that money back, and I don't want to do that to my buyer.
So what we have here is we have a deal. We have two mortgages. We have the main mortgage and we have a second lien, right? So we have $142,000 and we have a $38,000 second lien. You put $15,000 into the deal, and it needs $30,000 worth of work, right, on
Correct.
the property. So the underlying debt for everyone who's watching, when you're taking it over, now his total basis is different from the underlying debt, right? But the underlying debt in the deal itself is the 142 and the 38, and that's what Mark is responsible for paying. That's what he purchased the property at, and he has $15,000 of his own money when he bought the deal. So those are the two mortgages. So when we're doing a wrap mortgage, what we're saying is, okay, those two mortgages are staying in place when we turn around and resell the property. So Mark, what are you planning on reselling the property for?
$299.
$299. So
Yeah.
Marty, if you'll draw a big circle around both of those little circles.
All right.
What we're doing is when we sell the property, we're creating a new loan that is larger than both of these underlying liens, okay? And that's going to be $249. So if you could write $249 in there.
Okay.
No, $299.
$299. Oh, $299.
So $299 on the big circle.
On the big circle.
All right. So
what you have now, for the guys that are watching, on a wrap mortgage, you have an underlying debt of the two liens, of the 142 plus the 38,000. So what's that? That's 50, 60, 70, 80. That's a $180,000 underlying debt. And then the new debt is $299 what you're selling it for, or is that the new debt?
That's what I'm selling it for.
Okay. And how much is going to be the down payment that you're asking?
Probably 10%.
10%. Okay. So Marty, if you'll take that $299 and drop that by $30,000, please.
Drop it by 30.
Yes, sir. So $299,876, $269.
Correct. Yeah, $269.
So what you have is the debt difference between, just from a debt perspective, we're not talking about cash flow or anything yet. From a debt perspective, the difference in equity, we like to call like our equity spread, our net equity spread here, is going to be the 80,000 or the 180. The difference between 180 and 269. So what's the difference between 269 and 180? 80,000 bucks?
89,000.
So $89,000 is the equity portion in this deal. Now, the cool thing that you have is you're maintaining the underlying debt and you're reselling it to an end buyer for that difference, and you're essentially utilizing that underlying debt to resell it and provide financing to that end buyer. That is the difference, is that you get to sit back and say, hey, I'm a mortgage company, rather than owning the property and leasing it out with the potential option for that person to buy it.
Perfect. So, all right, let's kind of go in detail. Let's go through the numbers, and then we can kind of get into the part talking. So the payment on this one, the current lien, because the 38,000 is, I'm not making any payments. The first mortgage is $642 a month for that first lien of the 142.
Okay. So you got 642 is the first lien.
Correct.
And what are the taxes and insurance?
They are monthly escrows. Let's say $500 for monthly escrows.
All right, so $500 for monthly escrow. So we're in at 1142.
Yep. Now the buyer is responsible for the escrows. Isn't that correct?
Yes, but it's good to understand what that is. And the reason why that's important is when you do an escrow analysis per year, it's going to adjust, right? And especially if there's a overage or shortage, you want to know what that difference is, because you're going to have to turn around and pass that on to that buyer. And that will be your responsibility to communicate that every year. Hey, this is the adjustment with taxes and such. So what is this? So there's no payment on the second lien. When does that payment start?
It's a balloon. It doesn't have to be. It was a forbearance, so it doesn't have to be paid off until the loan's paid off. The house is, when it's at that time. Does that make
32.
sense?
So, yep. So on a forbearance like that, guys, this is actually amazing for those who are watching. When you get a deal like this, one, you need to make sure that your equity spread is enough. And if you are doing a full term, say 30 years or 15 years, you need to make sure that that amount's gradually being paid off. But in a situation where you put into like a balloon payment or something where you're planning on maybe selling the note after a few years, as long as you have an equity spread there, you can do a lump sum payoff in the future or negotiate that down. So right now your total payment's $642 plus tax and insurance, which is $1142. So what are the potential rents on this property?
$2250 in that area. So how I was going to do it, I was going to do a 30-year term at 6.5%. That would give the seller PITI 1701, right? 1701. And then when you add the escrows, it would come to about 2200.
That's perfect. That's how you want that's how you want to set it up. I think that's exactly when you're doing is figure out what the rents are and then back into what the payment is. And then some people might say the first thing is, well, why are you doing it 6% interest rather than 10?
6.5. Yep.
Right. So you're doing 6.5 versus 10. Well, this is something out there a lot of times, and I've struggled with this in the past. We'll say, okay, well, we want 10% interest. Marty, don't you want 10% interest? I mean, doesn't that sound sweet?
Every time.
Right. But if you need to back into a payment of $2250 and hey, that's what the normal rents are, what I like to do is prefer principal over interest, right? Because what you could do is lower your sales amount and increase the interest. But the reason why that's important is, or reason why you don't want to do that is if you ever refinance or you do a balloon, you have more principal. And so if you sell it for a higher principal amount and do less interest, you're able to capture that later rather than just relying on the interest to happen, even though interest, if you go to resell it, is more attractive to the end buyer when you resell it, like selling the note.
Got it. So my numbers here is, it looks like they're going to be responsible for 2201, right? And my payment, so I am going to be cash flowing roughly about $1,058 a month on this, just based off of my numbers, for that equity spread on it, because I'm paying 642. And then they're going to be paying me, backing out the escrows, they're going to be paying me 1701, and they're responsible. So Ronnie, let's talk a little bit about this. Like, what do you mean about the escrows that I got to relay that and pass it on to the buyer every year. Can you kind of go over that a little bit?
Yes. So on the underlying mortgage, right, on that 642 mortgage, if escrow is included in that mortgage, right, you are going to get a statement whether the increase or the decrease in that monthly taxes. Okay. And I would recommend potentially finding someone to protest those taxes each year to keep them low. But if there's a shortage, once you sell the property, if there's a shortage, you are going to get a bill first, right? And then once you get the bill, you're going to need to adjust that calculation for the end buyer and send that on to them to make sure they're now paying a new amount and communicating, because you are the mortgage company and you are adjusting that escrow according to the county. So you are going to have to communicate that going forward in the future.
Got it. Now, Cole had a good question there. Is your equity growing, the spread? Now, that is a good point, Cole, what he said. So on this particular first lien I'm taking over, they've paid 18 years. They have 18 years left on this particular note.
Out of a 30-year term?
Correct.
So if you do a 30 term, because you've paid down, or because the sellers paid down $12,000, there's more principal than interest going. And so, yeah, that equity spread is actually, if it was like a 28-year loan, the equity difference wouldn't be very much. But because it's paid down 12 years, your equity portion, like your equity payment portion of the payment, is going to cause a massive spread over years, especially as you get lower and lower in years. That basically, it's like a triangle, right? It's going to continue to grow. So you're going to go from an $80,000 equity, that's going to just gradually get bigger. And so let's say 5 years down the road, you'll have paid down more equity, but the majority of your payments will have been interest. And so you might be able to sell 5 years from now and have $100,000 spread. I don't know what those numbers are, but as that's going, you might be able to sell that note, make $100,000, walk out of it, pay off the underlying lien. And now not only have you done owner financing, but you've maximized your equity in the deal and maximized your interest in the deal by taking it off the top.
Nice.
Isn't that the beautiful part, Mark? Isn't that, Ronnie, like about like finding a deal where you can't wholesale to make 5, right? But if you kept it for 5 years and you did some of these strategies, you can make 150,000, right? Like real wealth.
Or technically, if you want to sit down and hold it, there's your retirement money, because it's going to be paid off in 18 years. You're collecting another 12 years at more than $1,000 a month off of that thing, $1,700 a month just off of one deal.
That's correct. Now, one thing that we want to think about, especially if you're going to go into long-term holds like that, get something expected to be paid off and go, is make sure that you have a plan for when that money runs out, right? And that was something that I looked at when I was building the first portfolio with my old partner, is as you're building it, realizing, hey, this is my long-term strategy, but let's say in 10 years, you're planning on being done, but there's 20 years worth of mortgages left. What are you going to do when that runs out? Because that could be a hard stop if you go 5 years and then you're like, hey, I'm going to live on it. If they're all wraps, and this is why you want to kind of vary your strategies, if they're all wraps, that might run out. So you might have, and what's amazing is you'll have in this deal $700 cash flow, then it jumps up to $1,700 for 8 years, and then it ends. And you need to make sure that you have a plan during that time where you're not just like, dude, it's sweet, everything's paid off. Well, what happens in 3 years when the property runs out? And this is why there's a short term, a midterm, and a long-term wealth plan while you're doing these properties.
So Ronnie, that's a little confusing. So what do you mean, what runs out?
Your mortgage.
My mortgage that I'm holding in 18, the one that is 18 years, when that runs out, or are you talking?
No, when the 18-year runs out, you're gonna be super happy.
Correct.
Because your payment jumps up by, in this case, $642.
Actually, no, it's going to be 17. It's $1,058 right now. So
okay,
it's going to jump up more. So it'll be almost $1,700 a month. But anyways,
that's correct. Yeah, so it's going to jump up. Well, from there, it's only going to be that way for 12 years.
Oh,
at the 12-year mark, after that, so you have the initial 18, then you'll have 12 more years. And when that 12-year period is up, your money stops. Well, in this case, the other thing that you're going to want to be aware of if you decide to hold this deal, Mark, is that $32,000 doesn't need to be paid off until the end, right? So if you hold this to term, it might end and they're like, yo, you owe us 32 grand, right? So that is basically saying, hey, I'm not going to hold this for that. I want to maximize my interest up front, sell the note, pay it off, and get a spread so you don't run out of money in the long term, right? You don't have a $32,000 check at the end.
Good point. Really good point. So before we jumped on, you're kind of like, we're talking about why is I doing a wrap versus a lease option or a contract for deed. Let's talk about that a little bit. Like what you mentioned before, why would we use a different strategy? Like in my case here, the reason why, like I said a few minutes ago, like the reason why I'm thinking wrap is because the end buyer, he's going to have to put some money into this property versus I love lease options, as you guys know.
Yep.
That's usually my go-to strategy because, if anything happens, it's easy to take the property back.
So why are you deciding to do a lease or a wrap on this deal instead of a lease option? Like, why are you deciding, hey, that's why I want to go down that route?
For me, I would love to sell it as a lease option. However, I don't feel comfortable having somebody put $30,000 into a property that they technically they're not on title yet. They're just, they have an option to purchase it. So God forbid if something happens and they can't get the financing in 3 or 5 years, then they're going to lose that money. And I don't want to do that to my end buyer. Sure, I could give him the money at the end or something for the amount of money. That could be an option. But I just feel in this case, it's easier to find that buyer. But we can talk about that, the buyer explaining the difference. But that's how I'm looking at it. Maybe you guys have a different point of view.
Yeah. So I think that's a really good point from my side, is looking at and saying, okay, I'm going to be the mortgage holder, right? Instead of being a landlord, even on a lease option, and that guy being like, man, I don't own this property. I gotta, now they're own, and they have this pride of ownership, right? This is mine. I'm willing to invest my money. And then they basically just take responsibility for the property, and it makes it easier to sell. Because the other side that I would imagine from your side, Mark, on this deal is you don't want to front $32,000 to do the repairs.
Correct. And I wouldn't have mind if we weren't giving the seller $15,000. I don't want to be into it for $45,000, really $50,000 for closing costs. The deal doesn't make sense. There is good cash flow on it. So it does make sense where, it can help the seller, helps the buyer. But again, I'm not going to want to come out of pocket that much capital to be able to take down a deal. I'll be out of pocket about $50K on that. And it just doesn't make sense.
Yeah. So, and in this scenario, doing the wrap, you're able to make money up front and still maintain the cash flow. The difference is it's not a rental indefinitely forever. Instead, you're able to make money up front, you're able to make money cash flow, and you're able to make money on the end. And so really, when you analyze the strategy, it sounds like, hey, this option allows me to minimize my cash out of pocket and maintain my cash flow. Would that be correct?
Correct. Yep. Yeah.
And 100%. That's the difference between doing the lease option and doing the wrap is, hey, on this strategy, I don't have to come up with all this money out of pocket. Right? Where on some you might.
Yep.
And so I think that's a great example of just looking at the two different strategies and saying, because a lot of times people are like, well, what's the difference? They're both the same. Well, they're not. In this scenario, if you were to do one, you'd be out of pocket 50 grand. If you do the other, you make money up front.
Yep.
Marty, do you have any thoughts on that?
That's what I would want to do is make the money up front, right? I mean, yeah. And then Mark, I really appreciate the fact that you're thinking out for your buyer. We always got to make sure that whoever is going to be taking on this project, we're setting it up in a right way, right? We're doing, because there's a lot of, there is a lot of, bad actors. I don't think a lot of them, but there can be bad actors out here in this real estate game, and you want to do it the right way. And so I think thinking that way is always going to bring back positive rather than negative, right?
Yep, absolutely. I'm always, you always want to do the right thing for everybody. You want to put your head in a pillow, and it just feels good helping everybody out. You know what I mean?
Right.
you know, the other thing, another option we were looking at originally, I'm doing this with a JV partner. We were looking at, what do they call it? Subtail, if you will. Looking at almost like putting it on the market, but running the numbers that way. You know, we're looking at the realtor. We're going to use a realtor.
Yep.
We're going to do a credit back. We're going to list it for $269. We're going to do a credit back for the roofs, you know, because it needs a roof for like almost like $15,000 there, then commission. But when you back out all those numbers, we're only going to make roughly about $20,000. You know what I mean?
Right.
It's just, it doesn't make sense going that route. Sure, we can move it and grab 20K and be done, but then, you know, we have a great opportunity to cash flow $1,000 a month. Plus, as you know, when you do a wrap, you usually can sell it a little bit higher than you can sell from your premium because you're becoming the bank. You know, you have to definitely underwrite, especially if you're selling it, you know, because wrapping it is considered selling it as an owner finance deal. So you have to underwrite it and make sure they qualify through the Dodd-Frank Act in the debt ratio side of things. What can we get into that a little bit, Ronnie, if you don't mind?
Yeah. So I think on the, when I think of the subtail, because I actually love taking properties owner financing and turn around and retailing it. It's actually one of my very favorite things to do when it comes to creative financing. I've done a lot of wraps, right? In Texas, the lease option is not as prevalent. There's a lot more logistics around it, and so we did a lot of wraps. Okay. However, as I was learning sub 2 and I was going through and purchasing, it became a primary strategy in the negotiation with the seller. But a lot of times sellers don't necessarily want a 15 or 30-year term, but they're willing to do owner financing for a shorter period of time. And man, and I think it's underrated, the ability to take it sub 2, buy it with owner financing for the express purpose of flipping the property or listing it on the market. But like you said, if you decide, hey, this is a long-term play, we can win long-term, then why not go down that route? The thing you guys have to watch out for, and that we all have to watch out for, is, hey, what are the current compliance laws in your area, right? What are the federal and what are the current in the local area, what you can and can't do? And that's kind of where you're going at. So when you're wrapping a property, what you're doing is, as the investor, you're becoming a mortgage company, right? Like, Mark, you're not just renting the property. Like, you're literally you're the mortgage holder. And what's amazing is that I love to look around. It's like, who makes the most money in the world? It's the banks, right? So it's like, hey, I'm becoming the mortgage. Well, now I have certain responsibilities as the mortgage holder. To what Marty said, hey, I'm looking out for my buyer. I don't want my buyer to be exposed $70,000 on a rental, right? Like, that's intense.
Exactly.
Instead, let me be a mortgage holder. Let me provide financing to them to own this property. But now, as a mortgage holder, you want to make sure that they have the ability to pay this mortgage, right? That you're doing your due diligence to make sure they can pay and that they would be a responsible buyer. And that's why the Dodd-Frank and the different laws that are out there, that you want to qualify these people. So what do you do? Like, how do you qualify? Can you do that yourself? The answer is, as an investor, we need a teammate, right? We need somebody on our team. And who is that person? That would be a mortgage loan originator. Finding someone who is an RMLO or a mortgage originator and having them process our buyers, and then they give us the information, and then we can determine, hey, do they have the ability to repay this loan? And then we can offer that financing and that pride of ownership to that end buyer.
Got it. And do they, from the RMLO, what type of documents that they have to provide to make sure you're in compliance?
I'm not going to be able to go through all the documents off the top of my head. I could get the list. This is why a checklist is so wonderful.
I got it.
Essentially, they're going to pull their financial information, right?
Okay.
They're going to pull credit. They're going to pull the financial information. As the investor, we don't need a certain debt to income ratio. We don't need, all we have to be able to reasonably say is this person makes enough money to pay off this debt. right? This was the proof they gave me, right? And then as you talk to your mortgage loan originator, they're going to be able to walk you through, hey, we're going to need all this stuff from your buyer. And they're going to gather that information and give you a packet. And then from that packet, you're going to be able to say, okay, do I believe they have the ability to repay? This is why. Okay, I'm moving forward. Or, hey, no, I'm not going to move forward.
Makes sense. Marty, I have some more questions. Marty, you have any questions?
No, this is awesome, guys. This is an absolute masterclass.
I'm glad we actually have a deal and example on this one. So
absolutely.
Yeah. All right. So now let's get into discussing, how do you present this to your buyer, a wrap with an existing lien in place, and, how does that all look, and what is the pros and cons? Let's go down that rabbit hole.
That's great. So when you're presenting, the buyer is excited that they get financing outside of a bank, right? When you're marketing this, right? So when I push out a property and you start marketing it and people come to you and you say, hey, owner financing, that in itself creates an excitement. So our job when we're talking to the buyer is to not douse that excitement, right? But to say, hey, are you familiar with how owner finance works from a private party? And then you go on to explain, hey, this is why I'm able to provide financing to you. I was able to get financing, and that financing is the springboard, is the support for me to provide financing for you. And that's how we explain. Now, a lot of people will be like, hey, well, why would there's a risk. If that thing pulls, they lose their mortgage. But what you're missing out on is a lot of people aren't afraid of that if you can show them reasonably why that's the case, right? That's the case because this is allowing me to provide you financing where I don't have to come out of pocket. I'm utilizing my reputation, my credit, my financial resources to get a loan from either another private party or an institution. And I'm using that as the support to be able to provide it for you. So I'm taking the risk with the institution, or the institution that is providing the loan has provided that to somebody else, and the risk is on them, not on you. And that's where it provides you the opportunity to become a homeowner without having to qualify for a normal bank loan.
And there, that last sentence is really what sells it, right? This allows you to get into a home without you having to, to qualify with a bank. That's it. I mean, that really is it. That's what the people are going to listen for, and they're going to hear, okay, that is what makes sense to me. I've already tried this the other way. It's not working. So this is, if you want to have your own home, this is a way to do that the non-traditional way.
Perfect.
That's correct. Okay. And a big question that comes up, Mark, when you are owner financing, if they're concerned, right? And I would say 9 out of 10 people that are buying owner financing are not concerned because they're excited for the opportunity, right? They're excited that, oh my gosh, I've been looking for an owner finance home, right? Because they're not out there, right? They're out there more than they were 5 years ago, but they're not out there as much, right? You don't get to go on that market or go to a realtor and say, hey, send me all the owner finance homes, right? But one thing that does come up is, how do I make sure that the underlying lien is paid? And that's where, as the investor, making sure you have a good servicer, that, hey, my servicer is going to send you a statement and they're automatically going to pay the underlying lien from your payment. And as long as you have that person in place, it provides tons of credibility for that end buyer.
And who do you use for a servicer?
So it depends on your local area. So in Texas, there's you could do August REI. There's Moat Servicing in Texas. Different states are going to have different servicers. And then there are a couple people that are starting to go national. But what you have to watch out is, what are their fees? Are they going to service the entire loan, the underlying debt, and the wrap? Or will they just service the loan to your end buyer and you have to make the payment on the back end? Lots of people do things differently. The wrap mortgage, like them handling the payment to your underlying lien and receiving the payment from your buyer, a lot of times, they have just different fees and different structures for that because it's a lot of accounting.
All right. You see Cole's question there?
What are you seeing as your best avenue to dispo an owner finance house? So that's a great question, Cole. That is the key to getting the property sold. Mark, what are you doing to dispo?
I'm
Before
doing
I answer,
yeah, I'm doing Facebook. That's kind of where I'm doing Facebook, Zillow. It used to be Cozy, but now it's apartments.com.
yep,
Craigslist, getting into some groups, Facebook groups that are local for that particular property where it's located. But that's kind of where I'm doing on the disposition side, just kind of posting ads up. And then I have them coming into my VA screening them, making sure that, make sure that they have the money to qualify. What are they currently paying? Are they, screening them out, then doing a drive-by of the neighborhood. And then from there, if they're still interested, then my VA will set up a call with me. That's kind of how I'm finding my owner financing and my rent-to-own buyers. Now, I have a question for you. Do you want to piggyback off of that, Ronnie?
yeah. I was actually going to say, I think being able to tailor into where those buyers are at, and so what I like to do, and what I've done in the past is you can post them out there and get responses, right? But a lot of these buyers, they come from different cultures, and being able to cater to that culture. And what I've done, or what I've found the most success in 8 years doing this, is finding a agent, or not a wholesaler, but somebody who works with that community and is plugged into that community. So, for instance, a lot of my owner finance properties have been sold to the Hispanic community, right? That they're looking for owner finance homes for their families. And so, if you can find somebody that's plugged into that community, or plugged into that community on Facebook, because they have their own Facebook communities from the groups, from the radio ads and what that looks like. And if you're able to plug into those communities where you're looking to sell, that's what I've had the most effective selling process, is being able to say, hey, Edgar, I know that you are you are an agent mainly for Hispanics, right? Like that is your clientele. I have a property, or I have properties. Can we work out a partnership and resell? So that's been my number one source for selling, is creating those type of partnerships.
Marty, how do you find your buyers?
Well, that's an absolute bomb drop, right? Because you have to understand who are my buyers, right? So that's number one. You have to know your avatar. Who are the buyers that I've had the most success with, that have seemed to really want to go this route, So that's awesome. I think that's a beautiful way of doing it. For us, again, we're not doing that. We're not going that route. We don't do any wraparound lease option kind of things, rent to owns. So it's just so good to be here and watch you two go back and forth, because I'm telling you, this is just unbelievable information. And I think, as someone who should be doing that and looking at it as, hey, here's another tool in my tool belt, it's a slap in the face to kind of wake up and make sure I'm doing these things. So
that's why we brought all four of us together, and we'll bring more people on as we grow and stuff. But that's good, because all of us have strength in certain areas. And that's kind of like, I'm like, originally Ronnie and I were going to do this separately and have a call. And I'm like, hey, why don't we just do it on our podcast and, live, and let's just kind of go through the process, because we can provide this value out there to everybody. I'm going to jump back to it again, because I have another question for Ronnie, because I know we talked about this a couple months ago. Now, this property needs like, $25,000, $30,000 repairs. How do you know, like, the repairs are getting done, that they're not just going to take this property and you have to go back and, have an issue with the property?
That's great. Well, the real answer is, if you just turn around and provide the financing for the property, you are out of control. Like, you have no control, right? If I just turn around, or you just say, okay, I'm going to sell this. Hey, Mr. Buyer, this property needs repairs. Are you okay with that? You're going to do it. They're going to be like, okay, cool. And then you have no repercussion. However, what you can do is you can build in that paperwork. You can build in, hey, I'm selling this and these repairs need to get done within this time frame, or we're going to do them and add this additional lien on top of it, right? And so what you're doing is you're essentially saying, hey, these repairs need to be done, and then you're putting a fire under the buyer saying, if they don't get done, here are the repercussions, and this is how I'm going to walk that out. And so what I've done in the past is whatever those repairs are, go in and get a quote for all of this stuff, get a quote for all of it, and then on every single item, add your own. Think of forced place insurance with car companies, right? If you get forced place insurance, it's not $200 a month, it's $1,000 a month, right? It's something stupid. That's what you're doing. You're essentially saying, I'm forcing these repairs to happen. So you go get a quote, figure out what the cost is, and then build in and say, hey, I will fix them if you don't, but here's the cost if I have to do it. And you're essentially adding a forced place number on each item. And as you walk through each item, then you say, hey, you have X amount of time to do this. And whatever that time is, 6 months, 8 months, you're going to do an inspection and sign off on those being done. And if they're not done, you're going to do the report and you're going to add a lien to the property for the amount. And that's a way of ensuring us that we get to make sure our assets taken care of, right? That way it just doesn't deteriorate.
Yep. Well, especially this one, the roof's going to need repairs. And if they don't repair it, there's going to be water damage and it could cause much more damage. So that's good information.
That's right.
So
and you could choose the time frame too. Like Mark, right? You could say, hey, the house needs a lot of repairs, but the roof is most important. The roof needs to be done in 60 days. And in 60 days, I'm going to do an inspection. And here's what's going to happen if it passes. We're going to waive this. Here's what's going to happen if it fails. We're going to walk down these steps. And if you have that outlined from the beginning, that's key. Now, the question is, well, how do you bring that up? You just simply bring up that there's repairs on the property and you're willing to work with them, but we want to protect their house as much as they want to protect it.
Got it. So you put together a whole list. Do you make them sign all like a lien at closing that you can file it, or what's that look like?
Yeah, so you can do either a lien at closing, like a pre-signed one that you can file if you do the work. And I've done one other. I don't remember exactly how. I think it was held in escrow, where all the paperwork was held in escrow and not filed. And then once it was done, we essentially released it rather than like filing, hey, the lien's on the property. And that way, whoever you're using for closing just holds it and can let it go once you've done your inspection.
Got it. I like it. So I probably should have, this other question I should have asked before when we're on the talking about, sellers and we're talking about the Dodd-Frank and all that. So what's your guidelines when you're looking at a seller, making sure they qualify? Like what if they don't have the full down payment, but they need the money to be able to go to the repairs. They can't give you a large down payment and repairs together. How do you analyze it and how do you make that decision?
That's a really good question. And when it really comes, it's your choice. You get to decide what you want to do for your house, right? There's no federal guideline saying, hey, let me take 10%, or let me take 15 or 20. Like, you can ask for whatever you want based on your criteria. And this is where it comes in, like, what are you most comfortable with? The reason why 10% is like a standard thing that you hear is because it makes the buyer have to put money where their mouth is, right? They have skin in the game. And so if they only have so much money, it's your choice to say, hey, I'm willing to work with that amount, right? I'm willing to work with that. Or, hey, Mr. Buyer, do you have other options of getting more money in the next 6 to 8 months? Do you have taxes come up? How much money are you planning on getting? Are you willing to put that towards the property? And then what you can do is you can be creative in structuring that. So let's say in this scenario, let's say you find a buyer, Mark, and the buyer comes in and says, Mark, I love the property. I'm willing to buy it for $300,000. I'm even willing to put the money in for repairs and do the down payment. But here's the thing. I only have $25,000 right now, and I'm going to get another $30,000 probably in the next 6 months. I'm self-employed, I'm blank, I'm getting taxes, whatever it may be, right? I'm going to get this. Can you work with me? And then you can decide what that looks like. He's like, hey, I would like to do the work first and then pay the remainder afterwards. Or I'd like to pay a little bit up front, then do the work and release it. And so it is on us as the investor to say, okay, am I willing to do this or not? Right? I've done deals before where it needed $20, $30, $40,000 worth of work on a $120,000 house. And it was like, hey, instead of a down payment, you do the work, I'll then sign off on the work, and that is your down payment. Right? Because now the value went from 120 to 150, right? I sold it to him. Things went well, and I wasn't out of pocket very little money, but they put in $40,000 or sweat equity of $40,000. And every time they did it, we just did an inspection to make sure the work was up to our standard. And so now they took their own money, put it into it. We're 40 grand in. The whole point is, hey, do you feel comfortable that they have skin in the game? Because the worst thing that can happen from a rep standpoint is they stop paying. Right.
And how do you feel comfortable like that? Like, okay. And that's kind of why you do that lien, because if they don't, I mean, technically, I mean, if they're saying, like, say somebody's got $20,000 or 25,000, right? They're supposed to be putting it into the house, but they don't, and they get into this house with very little money. There's a lot of risk there involved.
Yeah, well, and there's not a lot of risk on them.
Correct. On our part, I mean.
Yeah.
I'm saying on our part.
Yeah, on our part, there's tons of risk, right? You got $180,000 on the back end.
Right.
There's 180 grand that I'm responsible for. But for them, there's no risk. Well, think of a tenant. Their only risk is their deposit, $1,100. Why do you think so many landlords get their places destroyed? Because they give the $1,000 and they don't care about it anymore. But if you give 30 grand, like, now you have, instead of, 1,000 or one reason to walk away, which is, this, you have 30,000 reasons to be like, yo, I'm not letting this go. I've got years of my money set aside into this property. And that's where you're feeling them out of, hey, how do I make sure my risk is covered? And it's covered by them putting skin in the game. And the less skin they have, the more at risk we are as an investor.
So how would that work?
The more secure we are.
So what would that look like? Let's say somebody has 25,000, right?
Yep.
Knowing they're not going to have a lot to give to me for the down payment. So the finance is going to be higher, but because they're going to have to use some of that money to go towards the repairs, how do you not make sure those repairs? It goes back to, that open escrow lien, but then if the risk is there, you have to go through the process. You have nothing as an investor. So what do you normally do? Do you get half of it, or how do you what would you do in something like that?
Yeah. So in a scenario like that, I would split the amount, like I would get cash for me up front, right? Because there are two reasons. One, I want to pay myself back based on how much I put in the property, right? Two, I want the money from them, right? Like, I want them to give me the money. I don't want them to decide, yo, I'm not paying. Like, I'm not putting it in. Another option that you could do is they could come with the full $25,000 to closing. That gets held in escrow, and then you release the money for the repairs.
Love it.
So that way you're in control. What's that?
I like that move.
Yep.
Yeah. That way you're in control, and it goes, and you can use that money to do the repairs yourself.
Got it.
That is another option.
Got it. So we got 10 minutes left, and I got two more quick questions. I want to talk about the insurance on a wrap, and then I also want to talk about, like, how we sell that note in the secondary market. So take 5 minutes on each, if you don't mind.
Yeah. So insurance on a wrap. This is what I'm going to say. If the best way, I'm not an insurance master. I'm not going to be able to explain it like 100% right here. Best way to do it is find someone who insures wraps. You want to make sure the underlying lien is covered. You want to make sure the underlying seller's covered. You want to make sure you're covered, and you want to make sure the end buyer's covered, right? You want to make sure every lien on this property is covered by the insurance and that it's insured so you get your equity, and it's not just your lien's insured and every other lien is insured. One of the big problems, so get a list of insurance providers. You can't just do one. Get a couple of them, and then tell them, this is the type of insurance I need. Go to one of these people and get insurance. You can't force them to use a certain provider, but you can essentially go through and say, hey, I accept or don't accept this insurance on this property. And so you want to have insurance people that you can send and go to them. And if you need recommendations, feel free to reach out to me. I can give the recommendations, but then they will walk through and say, okay, I want this. Because one of the problems that'll happen is people are trying to get the cheapest insurance. I had this on one that fell through. We didn't realize till 2 months afterwards, they only had fire insurance on the property. Like that was it. And it was like, yo, we can't, like, that's like, we can't do that. We need to adjust. So the best thing to do is get people who work with wrap mortgages, get them to work on you and get 3 of them. So you can tell the end buyer, hey, reach out to one of these 3 people. Okay. And this is the type of mortgage we need. Cool. As far as selling the note, that's the best part. Let's go into it. For me. Yeah. I mean, I like the cash flow. Don't get me wrong. But I love the big chunks of money. I think that's why I love wholesaling so much. So selling the note, what you're looking for, a quick tip is if you can build relationships with local banks. Okay. They are in the business of creating loan assets. And a lot of times they originate it, but banks also buy mortgages, right? And they buy high mortgages and they buy what they see as valuable assets. And there will be an acquisition department, right? There will be like a VP of acquisitions. And what they're acquiring is they're literally making relationships with other people, other banks, other institutions with loans to purchase. And then you want to approach them and say, hey, what are your requirements? Do you have like, does it have to be or does it have to be current? Can they not miss the payment over so much time? Does it have to be seasoned? Right? Do I have to have 2 years of payments? Do they have to have a certain credit? What are your requirements? Okay. And then what is the type of investment you're looking for? Right? Does it need to have so much principal and interest paid? Does it need so many years? Once you find out what their criteria is, then you can back in and they'll have what's called a bid tape. And they're going to want to know all the information. How much money this person put down? What was the term? Did they get qualified? Well, all these details. And if you can provide that to the loan purchaser, if you can provide all those details, they will pay more for the property. But if you're looking to get the max amount out of a deal from a loan sale standpoint, go to the local credit unions, banks. There are lots of people around who are looking to buy mortgages. Those are your best buyers. The second tier buyer is going to be private investors, right? That want to buy notes. These people, when you go to, typically want a greater discount, right? So instead of being able to sell it at, let's say, 85 to 90 cents of the loan, you're going to want to sell it for under 85 cents. And a lot of times people are looking for, when they put their money in, I want a 15% yield, right? So I want to be able to make 15%. That's not, your loan is at 15%, but the money they put in versus the equity and the cash flow, they want to make sure they're getting a 15% yield when they're purchasing that note. And that's something to be thinking of as you're going through the sale process.
Great. Good stuff. It's a great, I think you covered pretty much everything on it. Marty, do you have any questions on it? It was pretty interesting.
Trick with the local banks and credit unions. And anyway, the worst comes to worst, you're developing a relationship with your local bank and local credit union, right? So yeah, I think that's awesome. I think that's a great tip.
Nice. Any final thought? Like, what do you guys pull as final thoughts at the end of the episode? Let's go around the room. Final thoughts for doing wraps or creative financing.
Yeah, for me, it was really, there's so many ways for a deal to work. And if you're looking at things as just, and I'm guilty, as a flipper or wholesaler, or even just a burr guy, you're missing out substantially. And it really was an eye-opening experience. And there was a lot of aha moments that Ronnie and Mark, that you guys were able to give. So, and I think a lot of people that are watching this, start off as either just a rental buyer, a flipper, or a wholesaler. So this is kind of that next level thing. And I think what happens is when people go, well, I want to do creative deals. I want to do creative deals, right? You hear that a lot. I think what happens is, at least in my experience, creative deals happen when you have experience just in this world. Like I just want to tell the audience, it doesn't happen overnight. Like it can certainly, but for the majority of people, it's just being in this world for a long period of time. That's why you see those old folks that they do this stuff all the time in their sleep. And these young bucks coming in just trying to do one thing the one way, which is wholesaling, right? It's just give it time, be around these people, talk to people, ask questions. And I think that's going to really help out and get you where you want to be.
Well, I love that, Marty, because what you're doing is you're choosing a normal strategy, you're getting in the game, but then an opportunity pops up. That's what happened for me. When I first got started, I was wholesaling for 7 months. I met a guy. He's like, yo, we could do this. I was like, what are you talking about? He's like, no, yeah, blah, blah, blah. I'm like, so you're telling me I could call my old leads and see? Brought 7 deals to the table in a month and a half because I had all these leads that were in the back. I went through, called them all. And it's just, you find yourself like, man, and the question to ask is, how can I make the most money on this property? And sometimes the answer is, you can't make money at this price. I can't make money. But sometimes the answer is, oh, I could do a lease option. Well, I got to put X amount. Well, I could do a wrap. Oh, I can make money at the beginning, in the middle, and on the, okay, that's a cool option. You know, I could do an owner financing. I could put it on the market. Well, I'd only make 20 grand. Okay, well, what's the risk? And then you're weighing, and you find yourself with an opportunity in front of you. And I think that's the key, is what do I do with the opportunities in front of me? What's part of my tool belt? And if I don't know it, can I reach out to somebody and get help? Final thoughts for you, Mark.
Real quick, you see Cole's question there? I've never heard of this company.
Yeah, I have never sold on a paper stack. I'm not familiar with that, Cole. I've never done that.
No, I think it was a great episode. I'm glad we actually went through a deal. I appreciate it. Like what Marty was saying, I love creative financing. I just, my first deal, I don't have enough time, but I was 19 and it was a mobile home and I had no clue what I was doing. This guy called me up, goes, hey, I got this mobile home for sale. I put up that we buy houses. He goes, it's worth $21,000. Give me $18,000 for it. I'm like, I don't want a mobile home. Calls me back a week later. Hey, give me $15,000. I go, I'm not interested. A couple weeks go by, and he goes, hey, give me $12,000. It's worth $21,000. I'm like, do you own the land? No, it's a mobile home park. Not interested. Calls me back a month later. Goes, give me $6,000 to this mobile home. It's worth $20,000. I'm like, dude, I'm not interested. At this point, I'm like, I'll give you $3,000 for it. He goes, come on, give me $4,000. I go, I'm not interested. Give me $3,000 for it. So he goes, all right, I'll do $3,000. I said, this is what I'll do. I'm going to have somebody come out, inspect a property, hung up the phone. It was back in the classified ads. I was 19, put an ad in the paper, mobile home for sale, $25,000, owner finance, $3,000 down. First lady called up. She went, looked at it. She gave me $3,000. I bought the mobile home with it. Created a note. I created a note for $279 a month at 7% over 7 years. I was 19 years old in school, and it was my car payment for 7 years. So that was my first, and I'm sure the paperwork was all screwed up.
Bro, I love that, because that's exactly what it takes when you're getting started, is you're trying to figure it out and go. A buddy of mine, an old buddy of mine, he did similarly to you. Is he downsized his life. He went into mobile homes, bought him a bunch, owner financed them. Like, there's all kinds of cool stuff. So,
but that was my first one. But anyways, great show. Appreciate it, Ronnie. And we'll see everybody out there.
Week. Yep, out there Tuesdays we come together. It's either Marty, me, Mark, or Gabe, and we're here. If you guys have questions or thoughts, feel free to put them down. If you'd like us to go over something, let us know. Otherwise, until next time, peace.
See y'all.